Welcome to Class 2 Unit 1 of the Black Stock Investor video course. Today we're going to talk about the stock market, stock exchanges, market cap, NASDAQ, AMEX, NYSE, indexes, the market, the Dow Jones, the S&P 500, small caps, mid caps, large caps, mega cap, stocks, floats, restricted stocks, free float market cap, and supply and demand. So stay tuned. The stock market is very similar to a mall. Just imagine you wake up one Sunday morning and you walk to your local mall. And once you go inside your local mall, it contains a bunch of different smaller stores. So essentially a mall is just a giant building, which is a business, that contains a lot of smaller businesses. You might go into the mall and you might see AT&T or Baby Gap or Avis or Auntie Anne's or Banana Republic, Bank of America, Barnes & Nobles, Bath & Body Works, and so on, Belk, Best Buy. The stock market is very similar to a mall in that it is basically a collection of markets and exchanges where regular people like you and me can go to and we can buy and sell shares of publicly traded companies. You might visit the mall one day because you want to buy 2 or 3 new pairs of Nike shoes. You visit the stock market because you want to buy 2 or 3 shares of Nike. And those shares will give you a small piece of ownership or equity within the company. Just like you have malls all around the world, you can go to a mall in New York, you can go to a mall in California, in Florida. You can also go to a mall in Africa or Asia or Japan. You have stock markets, also known as stock exchanges, all around the world as well. A stock exchange, again, is just a market in which shares of publicly traded companies, corporations are bought and sold. The biggest mall in America is known as the Mall of America, which is located in Bloomington, Minnesota. The largest stock exchange in America is the New York Stock Exchange, NYSE. The New York Stock Exchange dates back to 1792 and is the largest exchange in the entire world. Many of the oldest publicly traded U.S. companies are listed on the big board, as they call it. The other 2 big U.S. exchanges are the AMEX and the NASDAQ. But again, just like malls, you have stock exchanges all around the world. You have the Tokyo Stock Exchange, the Shanghai Stock Exchange, the Hong Kong Stock Exchange, Euronext, Shenzhen Stock Exchange, London Stock Exchange, the Toronto Stock Exchange, and the Bombay Stock Exchange. Many times when you hear people talking about the stock market, they'll talk about it in the way that you would talk about a close friend or a relative. They'll say things like, the market is down 50 points today. Or, the market has been hitting a lot of new highs and records lately. Now is not a great time to invest. You might also hear them say something like, the market is up more than 30% this year, and it just seems like it's going to fall soon because it's just way too high and it's doing way too well. So when you hear people talk about the market in this way, they're usually talking about the U.S. stock market specifically, and even more specifically, they're talking about the Dow Jones Industrial Average, which was created by Charles Dow and Eddie Jones. Dow and Jones were 2 reporters in their 30s that started a publishing paper you may have heard of called the Wall Street Journal. It was created in 1889. Like its modern day version, the Wall Street Journal reported current financial news. Dow and Jones compiled stock prices of large important companies in the U.S. and calculated indexes to track the performance of the U.S. stock market. So let's talk about indexes, because as a stock investor, you'll see them and use them quite often. So imagine, let's go back to the mall analogy. Imagine you're in the mall and you get lost, right? And so you go up to a directory, and a directory has a list of all the different stores inside of the mall. Well, a stock market index is similar to a mall directory in that it tracks companies. Stock market indexes around the world are powerful indicators for global and country-specific economies. In the United States, the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite are the 3 most widely used indexes for both the media and investors. So one of my favorite indexes that I like to use to track to see how the stock market is doing is the Standard & Poor's 500, also known as the S&P 500. Like the Dow Jones Industrial Average, the S&P 500 tracks 500 of the largest companies in the U.S. stock market. As the name S&P 500 suggests, the index tracks 500 stocks. These 500 big companies account for about 70% of the total market value of the tens of thousands of stocks traded in the US market, whereas though the Dow Jones represents less than 20% of the total market value of US stocks. So from that, you can already say that the S&P 500 is a much broader and better representation of the US stock market because it just tracks more stocks. So if we do a quick Google search, what companies are in the S&P 500? We can scroll and go down to here. And as you can see, there are a lot of different companies on this list. 500. Well, they're actually more than 500. I think they're like 505 or 506 stocks listed underneath the S&P 500. But as you can see, there are name brands that you recognize: 3M, Adobe. Who else? Who else do we have here? Amazon, American Airlines. Who else do we have? Apple, Apache, just a bunch of different companies. And if we scroll up to the top right here, you can see the other indexes: the Dow 30, again the S&P 500, the NASDAQ 100. You also have a commodity right here: gold, another commodity, oil, and I believe euro to US dollar. This is like forex currency trading. But yeah, so you have the S&P 500 that tracks 500 different stocks. You can click over here and you can go to the Dow Jones, which tracks a bunch of different other stocks. You can go to the NASDAQ 100, which tracks a bunch of different other stocks, and all these are different indexes: the Dow Jones, S&P 500, NASDAQ 100, FTSE 100, and so on and so forth. All these are just indexes that track different sets of stocks. The one I use the most is the S&P 500. I'm the most familiar with this, and I believe it's one of the most reliable ones because it covers a broad range of different stocks and different industries. And all of these are mainly large cap stocks. We'll get into what large cap means in a minute, but basically it's just large companies. Before we go any further, we need to talk about market capitalization, which is a term that I'll define in a minute. But I want to say this: when you're investing in the stock market and you're looking at businesses and you're analyzing if you should invest in a company or not, size truly matters. From my perspective and from my experience, larger companies are usually a little bit less risky than smaller companies. Larger companies usually have a recognizable brand name. They've been around for a while, maybe 5, 10, 20 years or more. They usually have a long history of the company existing in different economic situations, ups and downs, recessions sometimes, collapses of different sorts. And so large companies offer usually more data that you can use to determine if you should invest in a company or not. Whereas a lot of small cap companies, a lot of micro cap companies are newer-ish, and they don't have as much data to go by, and their brand names aren't recognizable. And the stock market is like survival of the fittest, basically. A lot of small companies do not make it. Whereas though larger companies, in order for them to even get to that level of being a large cap company or a mega cap company, they have to be very successful in many cases to stick around. They have to have continuous sales. They have to have continuous growth. They have to have people behind them that know what they're doing to keep the business alive. And so in many cases, big companies, large cap companies, mega cap companies, even mid cap companies tend to be less risky. This is not 100% true. You will find some small companies that are doing extremely well that are better than bigger companies. But generally speaking, large cap companies are generally safer. Now, let's get on to that definition. Market cap, shorthand for market capitalization, is a way of defining the size of companies. It is simply the number of outstanding shares of common stock times the stock's per share price. For example, let's go back to the example that we always use, Mike's Burgers, which is a fictional company that I made up. Let's say Mike's Burgers has shares outstanding in the amount of 300 million, meaning they have 300 million available shares for you and me, average investors, or whoever wants to invest to buy. They have 300 million outstanding shares, 300 million slices of pie. Let's say the current market price for one share of Mike's Burgers is $10. In order to find a market cap, all we have to do is multiply the shares outstanding, which is 300 million, times the current share price, which is $10. So the market cap for Mike's Burgers will be $3 billion. So this stock will fall into the mid-cap size category. Pretty much any stock on the stock market right now will fall into one of these categories. Mega cap stocks, 200 billion or more. Large cap stocks, 10 billion to 200 billion. Mid cap stocks, 2 billion to 10 billion. Small cap stocks, 300 million to 2 billion. Micro cap stocks, 50 million to 300 million. And there's one I'm missing, which is, I believe, the one I'm missing is Nano, which is below 50 million. It's just like a very, very small company. So if we take a trip to one of my favorite sites, which is Yahoo Finance, and we will spend a lot of time here in this class and a couple other sites. So we go to Yahoo Finance and go to symbol lookup. And let's see if we can pull up Microsoft. Let's see if we can pull up Microsoft. The ticker is I think it's MSFT. Yep, Microsoft Corporation. We click that. We get a quote. The current price is going for $208.70. Let's see if we can find a market cap. Market cap is 1.579 trillion. Trillion. So this would be a mega cap company. This would be a mega cap company. If we go to another company, what's another company that I know of quickly? Ford Motor Company. Ford Motor Company, it has a market cap of 27 billion. So I believe that would be a large cap company, if I'm not mistaken. That would be a large cap company. What else can we look up? We can look up what's this? CSE, I think that's Cisco. Let's see what's going on with Cisco. It's not coming out. Let's go. CS. Oh, here it is. Okay. Cisco has a market cap of 180 billion. So this is damn near a mega cap company. This is a large cap company though. So, if you go on Yahoo Finance, you can quickly see what kind of market capitalization a company has. So now that you have a better understanding of what market capitalization is, you will have a better understanding of how the S&P 500 works once I break it down to you. Again, market capitalization is just the price of a share. Let's say Microsoft's share is $10 and they have 10,000 shares outstanding, or 20,000, doesn't matter, some number. You just multiply the amount of shares outstanding times the share price and you get market capitalization. And then once you get that number, you'll be able to determine if a company is small cap, large cap, micro cap, mega cap, and so on and so forth. So if I type in S&P 500 inside Google, it'll pull up the S&P 500 index. And this might look intimidating at first, but let's talk about it. Let's break it down. Let's bring it out to 5 years, and then we'll bring it out to the max. So there's a lot going on this graph. It looks a little bit intimidating at first, but once we break it down, I think you'll understand it. So on the y-axis, which is right here, you have some numbers counting down: 3,500, 3,000, 2,500, 2,000, 1,500. This is more or less just a scale to track how much it has grown over however amount of years or time you select. So I can choose 1 day, 5 years, 1 month, 6 months, year to date, 1 year, and max, and of course 5 years. So it's just a scale showing and tracking how much this has grown over the amount of time you select. On the x-axis right here, this shows the dates. So you can go to a date like December 23rd, 2016, or you can scroll up and go anywhere. You can go to this dip right here, which is March 20th, 2020, which represents the coronavirus dip. But you can go anywhere. And once you go anywhere, it just shows you where the index was on that day. So on October 13th, 2017, the index was at 2553.17 points. Now, what is this large number right here? What does that number actually mean? This number is pretty much a combination of all the market caps of all the 500 stocks on the index. It's more math involved with that to break it down to this small number right here. But just think of this as a total combination of all the market caps of all the stocks on the S&P 500. So this is literally the combination of 500 different stocks you would need to come up with this number. And they break it down with some sort of other algorithms that I'll talk about in a minute. But if you were to add up all the stocks on the S&P 500, you would come up, when I mean add up their market caps, you would come up to this number. The market cap for this index is 27 trillion. Again, if you added up all the market caps of each and every stock of the 500 on this index. And when they say free float capitalization weighted index, what they're basically saying is they only consider the stocks that are able to be traded. In any company you can think of, there are stocks within a company that cannot be traded because they're restricted. They might be owned by executives. They might be owned by institutions. And so a free float capitalization weighted index only considers stocks that can be traded by regular people. It doesn't include restricted stocks. So in order to get the S&P 500 index number, you add up all of the free float market caps of each stock and divide that number, 27 trillion, by the S&P's proprietary algorithm, which is also known as the index divisor. The index divisor does two main things when you divide it into the 27 trillion. One, it brings down that 27 trillion to a more manageable, recognizable number that can be tracked. And two, that divisor ensures that events like stock splits, special dividends, and buybacks don't significantly alter the index, because stocks change all the time, companies split all the time, companies buy their own stocks back all the time. And so without the divisor, I mean, the number would just be really, really high. 27 trillion is a really high number to manage. It would also be extremely hard to keep track of. And so the divisor helps to pretty much make the index readable and usable for humans. The S&P 500 index number, this large number right here, 337343, goes up and down all day as stocks trade, and is largely affected as each of the 500 plus stocks that it tracks, the prices change, the market capitalizations change, and so the index changes. And that percentage that you see on the right hand side of the index number, and that negative number as well, those are indicators of how much the stock has either went up or went down during the day. If we bring this scale out to the max, you get a nice long chart to see how the S&P 500 has grown since its birth. So from August 15th, 1980 till now, it has grown significantly. It's had dips here and there. You know, had a dip around January 3rd, 2003. I'm sure you can track that to some event that happened there or something that was going on with the economy. You have another dip here, 2009, the housing crisis. You have another dip over here, the coronavirus. So a lot of different things can affect the index, the economy, the elections, the overall health of the GDP in America, unemployment. I mean, just a number of things can affect it. I mean, it's almost like an unlimited amount of things can affect this index. But as you can see, if you invested your money early on in the in this index, or your portfolio followed this index, you would have had some nice returns over the years. You know, this has grown. Again, it has had dips here and there, but overall, from the beginning till now, it has grown significantly. Even in the past 5 years, it has grown a lot. So this is, again, a great benchmark to see how your portfolios are growing or performing compared towards this index, the S&P 500. The final thing I think we should talk about in this course is how daily stock prices are set. Stock prices pretty much change as shares are bought and sold. For stocks that are heavily traded during the day, their prices can change a couple times a second, hundreds of times, thousands of times during the day in many cases. There are a whole lot of things that can affect the price of a stock. Media reports can affect the price of stocks. Let's say some news came out that GDP was down or that unemployment rates were extremely high. That could affect the stock market. The federal government can influence the stock market heavily via bailouts and just giving money to corporations. As we've seen during the COVID-19 pandemic, a lot of companies have been bailed out, especially airlines. Inflation, war, all of these things can affect stock prices. But the main things that affect stock prices are just simple supply and demand. If there are more buyers in the stock market for a stock than sellers, the price will go up as buyers raise their offers to entice shareholders to sell. If there are more sellers in the stock market than buyers, the stock price goes down as sellers lower the price they are willing to take to attract buyers. Realistically speaking, the price of a stock is equal to whatever a willing buyer and a willing seller agree upon. My goal as a value investor, and this should be your goal as well if you're looking for long-term gains in the stock market, is to buy stocks as cheap as possible. You want to buy stocks as close to their intrinsic value as possible, meaning the value that they actually are. Many stocks nowadays are vastly overpriced, especially a lot of these tech stocks, and it's because a lot of people have emotional attachments to these stocks and they aren't investing in the stock for rational reasons. They just want to buy shares of Apple or shares of Tesla because they like the company, not necessarily because the company has great financials or great books or great data that supports them investing. They like the Cybertruck, they like iPhones, they like Macs, and so they dump their money into the stock because they have an emotional attachment to the company. We'll talk about Mr. Market in a future video. Mr. Market is a character that Benjamin Graham created, Warren Buffett's teacher, and Mr. Market is somebody that you don't want to be, but we'll get into who Mr. Market is later. This class ended up being longer than expected, but I believe that we covered a lot of ground, so I'm excited about that. If you have any questions or concerns, leave your comments below and I'll get to them as soon as possible. I will see you in the next video. If you enjoyed this class, please subscribe to the channel. We post new classes weekly and all of our content is free. As it costs time, money, and energy to make great content, please consider becoming a sponsor to our channel by visiting www.patreon.com/blackstockinvestor. And if you have any questions or concerns, please leave a comment below and we'll get back to you as soon as we can. See you in the next video.